Have you ever looked at your bank account and just wondered how on earth you're supposed to turn that number into enough money to one day, stop working? It's a thought that crosses literally everyone's mind. You see these stories online about people who started with next to nothing and built incredible wealth. You hear about the stock market investing complicated-sounding things. Maybe you think, that's not for me. That's for Wall Street guys in fancy suits. The truth is, it doesn't have to be that way. Not at all. Building wealth isn't some secret code only a few have cracked. It's actually a lot simpler than most people make it out to be. That tool exists. It's one of the best ways to begin your journey. That's where an ETF comes into the picture. All right, let's get right to it. What is an ETF? The letters stand for Exchange Traded Fund. I know that already sounds a little boring and technical, but stick with me. Let's use a simpler analogy. Imagine you want to buy some fruit. You could go to the store and try to pick out the single best apple, the perfect banana, the most delicious orange. This takes time and effort. What if you pick a bad apple? You've wasted your money on that one piece of fruit. An ETF is like buying a pre-made fruit basket instead. The basket contains a little bit of everything. A few apples, some bananas, a handful of grapes, a couple of oranges, all bundled together. In investing terms, that basket holds stocks, bonds, and other assets. So, when you buy one share of an ETF, you're not buying a tiny piece of one company. You're buying a tiny piece of a whole collection of companies at once. It's a way to spread your money out instantly. Now, a lot of people get confused between buying an ETF and buying a stock. Quick. It's a fair question because you buy and sell them in the exact same way on the same platforms. When you buy a share of a stock, let's say one share of Tesla, you're buying a tiny piece of ownership in one company. If Tesla soars, you make a lot of money. If Tesla tanks, your investment can lose a lot. On the other hand, when you buy one share of an ETF, you aren't tied to one company. Say it tracks the S&P 500. It bundles the 500 largest U.S. companies. Buying one share gives you a tiny sliver of Apple, Microsoft, Amazon, and 495 other big companies. If you're new to investing, the sheer number of choices can be paralyzing. That's precisely why ETFs are such a phenomenal starting point. The first and most obvious reason, instant diversification. As a beginner, you don't have the time or expertise to research hundreds of individual companies. An ETF does all that heavy lifting for you. Buy one single ETF and be more diversified than someone handpicking 10 stocks. Lowers your risk profile, immediately helps you sleep better at night. Second, ETFs are incredibly low cost. Most broad market ETFs have extremely low expense ratios. We're talking fees as low as 0.03%, about $3 per year on $10,000. Third, they are transparent and simple to understand. You can see exactly what you own. Finally, ETFs are accessible to everyone. You can literally start with just a few dollars. Instant diversification, low costs, transparency, accessibility. Okay, so you're convinced. Now, how do you actually buy one? How much cash do you need? You need a brokerage account. Fidelity, Vanguard, Charles Schwab, M1 Finance, Robinhood. Opening an account is free, usually takes about 10 minutes online. Link your brokerage to your bank to transfer money. You can start with any amount. Seriously, any amount. Fractional shares mean you don't need a full share. Log in to your brokerage. Search the ETF by ticker. Click trade or buy. Enter a dollar amount like $25 or $50 and confirm the order. Congratulations. You're an investor. The key is consistency. Set automatic transfers and make it a habit. So, which fruit basket should you buy? There are thousands of ETFs out there which can feel overwhelming. But don't worry, you only need a few basic types to build a diversified portfolio. Broad market index funds are the most common recommendation for beginners. They try to mirror a major market index like the S&P 500. A classic example, Vanguard S&P 500 ETF, VEO. Want broader exposure? Consider a total stock market ETF like VTI, nearly 4,000 U.S. stocks. Don't have all investments tied to one country. Vanguard Total International Stock ETF, VXUS, covers thousands of non-U.S. companies across Japan, Germany, and emerging markets. There are also sector-specific ETFs, tech, healthcare, real estate, energy. Invesco QQQ QQQ, tilts heavily toward tech giants like Apple, Microsoft, and Google. For most beginners, start simple. A broad market US ETF is the perfect foundation. Start with VIO or VTI. Combine US and international ETFs for true global diversification. Start simple, stay diversified, and keep costs low. Let's bring this all back to the ultimate goal, retiring comfortably. How does buying a share of VOOO for $25 help you achieve that? The answer lies in the magic of compound growth and the power of time. When you own an ETF, you make money in two main ways. The first is through appreciation. The second is through dividends. You can take these dividends as cash or automatically reinvest them to buy more shares. This reinvestment is where the real magic happens. It creates a snowball effect. Over 20, 30, 40 years, small, consistent investments become a massive nest egg. Starting early, even with small amounts, gives your money more time to compound. ETFs are perfectly suited for retirement accounts like a Roth IRA or a 401k. With a Roth IRA, your growth and withdrawals in retirement are tax-free. So the plan is simple. Open a Roth IRA. Set up automatic contributions. Regularly buy a low-cost, diversified ETF like VOO or VTI. Then let it sit. Ignore day-to-day noise. Let time and compound growth do the work. By using ETFs, you're building a robust, low-cost machine designed to churn out wealth for your future self. Please like and subscribe. It helps reach more people.